let's get back onto earnings season, which is now officially in full swing. Results from JP Morgan, Citi, Morgan Stanley, and of course Wells Fargo. David Ellison runs point on the Hennessy Large Cap Financial Fund. David, market has seemed, at least initially, seemed to like some of these big bank earnings. Do you think that enthusiasm is justified?
Well, I think the stocks have been down a lot, so the fact that they're up a little bit tells me that the world didn't come to an end again. So I think the stocks have been really bad, so the fact that they're rebounding is sort of a sigh of relief. I think generally the fundamentals are good. I mean, obviously the margins expanded because rates are moving up, and they're a primary beneficiary of that. But what you're not seeing is any real credit deterioration. So you've had a massive move in rates. You've had a massive move in the market that has gone down, that's taken money away. Sentiment is not great on Wall Street, and yet you don't really see any movement in credit. So it's interesting to note how strong these banks are, even though we have this fear of recession and the end of the world that seems to be the talk every day.
Yeah, I mean, the end of the world trade can, at least from what I've been told, only be right once, and you hope that we don't reach that point. But, when you think about some of the activity even that we're seeing here on the day as well, David, as the markets have slipped back into negative territory there, we had a moment ago all three major averages in negative territory after beginning the day pretty strong in what seemed like would be another add-on to yesterday's momentum, even though it was a whipsaw day yesterday. As you kind of look into the rest of this quarter, what would you need to see in order to have some confidence that a bottom had been set in during this fourth quarter, going into what economists are expecting in a recession at the midpoint sometime 2023?
Well, my general broad thoughts are that, we've had a pretty good move in rates. 2 years ago, I think the 2-year was like 15 basis points, and now it's, 4+%. So I think we're through the bulk of the rate increases, meaning we're not going to go to 8 or 10% on the 3-month T-bill. At least that's my opinion. I think what we're heading into now is an earnings issue for all of the companies, not all of them, but enough of them. Obviously, the financials aren't seeing any earnings issues. There's concern that there will be, that rates will go up, credit will kick in, loan demand will decline. And I think it'll be interesting to see what happens the next couple of weeks as the non-financials start to report and tell you what's happening away from the financial economy. Again, the banks came into this downturn very strong, very conservative. They don't want to make bad loans. They got plenty of capital. They're benefiting from the rise in rates in the NIM. So this group is not really indicative of what's happening out there in the marketplace yet.
Well, there are some hints of it, right? If you look at this, David, in JP Morgan, for example, yes, net interest income doing fantastically, but if you take out net interest income, revenue actually didn't do as well. They're raising their provisions for credit losses. They're seeing a decline in lending already. How much worse do you think some of those indicators, even at the banks, are going to get worse?
Well, I guess as an investor in these stocks, to be completely honest, I am looking forward to credit troubles. I am looking forward to higher rates. I am looking forward to the market getting very concerned about the health of the banking industry, because that's going to generate the opportunities for me to buy the better names and outperform on the way up. So, that's the raw truth of what I do. Is, I don't want what we have now to continue, because I can't really compete with the other companies in the marketplace that grow, they create new products. We need cycles for this industry to really make money for investors. And my hope, again, I've been doing this for 40 years. I'm hoping we have a downturn. I'm hoping we have a recession. I hope we have higher non-performers that creates lower stock prices that I can buy as the economy recovers, the Fed pivots, and all that stuff.
Okay, so David, tell us, so what are the better names then? What are the ones that you're looking to get cheaper? What are the ones you're most excited about getting cheaper in this kind of tumultuous period?
Well, the ones that, are going to have credit problems. And I don't think the bigger companies are going to have that. They've just been too conservative. They're too liquid. So the smaller banks, the mid-tier banks, maybe not the real small ones, where they've made loans, the loan to deposits are higher, they don't have as much liquidity. If credit kicks in on a negative thing, then they'll hopefully go down a lot more and I'll be able to buy them. But right now, there's no problems in the industry. And this is the frustrating part for an asset manager. If there's no problems, there's nothing to get better, there's no reason for the stocks to go up. So we need things to go wrong for this group to get really attractive. And right now, the first 4 or 5 companies that have reported, everything's great. Non-performers are okay. Loan growth is okay. Yeah, they're reserving here and there, but they're just being super conservative. And I would do the same thing. We'll see what happens, but I think you'll see more issues with the economy in the non-financials for the next couple of months. I think that the struggle, the real challenges in the world is not the financial system. It's away from the financial system.
David, Wells Fargo is the top 10 holding in the fund. Does that company frustrate you? They had a couple, I would argue, 2 good comeback quarters to kick off this year. They come out here this morning. I would argue expenses are still high. They announced a charge. The home business under pressure. Auto's under pressure. What do you make of that name?
Well, this is a large cap fund, so I'm not going to own a $2 billion bank. So you have to own something big. But the valuation is reasonable. They've got a great historical franchise. They've had some management issues for the last 4 or 5 years, which have been very frustrating. Not quite as bad as Citicorp, but certainly they've had some struggles, and the valuation is just too cheap to ignore, and the embedded franchise value of those deposits is just too large and too powerful. And you're seeing the benefit of those deposit franchises now in higher net interest income.
Just while we have you here as well, David, there's an interesting tidbit within the consumer sentiment survey that had come out just a moment ago, and particularly as we think about the consumer and the higher end or higher net income consumer as well. If you see them start to be impacted to the same kind of detriment, or maybe not the same detriment, but as they're citing here, negative influence on their personal finances, the highest in 5 months, what does that start to spell out more broadly about where consumer mindset in the economy is trending towards?
Well, presumably, the Fed is doing or is making things happen the way it wants to have them happen, meaning they're slowing the economy down, and that's showing up in certain things. Obviously, stock prices are down. Home prices have stopped going up 2% a day. So I think the issue here is who's gonna really feel it more, and I just don't believe that the large financial companies, the banks, are gonna feel the real bite of this recession, at least not yet. It's going to be the other companies. It's going to be, the companies that have reported. Even, you look at Nike, and you look at, those companies are going to hurt a lot more than the banks are. The banks since 2008 have been in a box. They've been regulated. They've been forced to be liquid, forced to be conservative, forced to have tons of capital. And now that's paying dividends for them in a sense that they're not seeing the struggle. So you're not really seeing what's happening yet in the economy. And I think the financials are not a good example of that yet. And so I think the numbers you're seeing are going to impact the non-financials a lot more than the financial companies.
David Ellison, who runs point at the Hennessy Large Cap Financial Fund. Good to see you. Have a good weekend.